So thank you for coming. Today's topic, stock split effect on options, as I said in the email, and then another topic, beliefs and market conditions. So this is a very important topic. It's a short topic, only 3 slides, but you should understand the beliefs and market conditions. So what traders have beliefs, and when they are facing a different market conditions, how they act based on their beliefs. So you will find there are 9 different quadrants. You will find your situation in one of the quadrants. So I'll tell you how I go through every day, what the emotions I go through, and you will see yourself in one of the quadrants. So first, we cover stock split effect on option. It's important if you're trading options. It's important to know about the effect of a stock split. And you can read more by buying book or doing some literature. I have covered it's a short presentation about, I think, 15 slides. So you can dig deeper. All right. So stock split effect on option prices. That's what the topic is about. So what is a stock split? A stock split is the action a company takes that increases the number of its outstanding shares by dividing each share. So in simple words, a stock split is just increasing the number of shares and decreasing the value per share. So if you own 100 shares and they announce a 2-for-1 stock split, you will own 200 shares instead of 100. And if the value was $50 before stock split, it will be $25. So nothing happened in the books. Nothing changes in the book. It's just that they increase the number of shares, and there is a reason for the company to do the stock split, and what happens on the option prices, and what happens on the stock when the stock is going through the split. There are various stages. So you need to, if you understand the stock split and you understand what the stages the stock will go through, you can take advantage, and you can see, if you can see the effect happening, you know why it's happening. So you're better prepared. So whatever knowledge you get, extra knowledge, you're better prepared for trading and making money or investing. So I am always looking for to increase my knowledge, how I can improve. Every day I try to improve. At the end of the day, I say, okay, did I learn something new? Did I improve my system? Did what mistakes I did today? How many mistakes I did? Should I be doing the mistake again? So all this is all about increasing your knowledge about trading and investing and making more money. So stock split this is a definition. So let me give you an example. So if you see this example, you will understand immediately what's happening, and maybe all of you you should be knowing it already. So in case you don't know, then try to understand. So let's say outstanding shares before stock split. So company, let's say Apple. Apple has, I'm just giving you example. So this is for example sake. So let's say a company Apple, they have outstanding shares in the market, 1 million. So 1 million shares they have. And before the stock split, suppose the price of the Apple is $70. Just for example, Apple is trading at $70. Today, if they announce a stock split, that suppose the stock split happened today at open, and they had announced that it will be 2-for-1. So what happens? The outstanding shares goes by $2 million, increased to 2 million instead of 1 million shares. So before it was 1 million, now there are 2 million shares because they said 2-for-1. And the price will be split into two. So if the price was yesterday was $70, today it will be $35 at open. So nothing happened. The total value is the same: 35 multiplied by 2, 70 multiplied by 1. So if you own 100 shares, you will see you have 200 shares, and then you will see that the price is $35. So sometimes I receive email or you get shocked. What happened? The price was $70 and now it's trading at $35, and then your chart is also messed up. So a lot of quotes are not right and they messed up the chart. So when you're looking at the chart, you see a big gap down. So without knowing that the stock split, you have not seen you had 100 shares and now you have 200 shares. all you're looking at the price is $35, maybe on your mobile phone, and you see Apple trading at $35. Damn, it was $70 yesterday. So you're panicking, and then you sell, or you're upset. So you have to understand this, that the stock split happened, and now you have 200 shares, and that's the reason. So what happened after the stock split? So let's say the stock split happened today at $35. Usually the stock starts moving towards its pre-split price. So if the company is very good in terms of growth and the revenue, the stock will move towards it will start moving towards its pre-split price. So if the split happened and the price is $35, eventually, if the company has growth, the price will go towards $70. And they say that it takes 18 months, sometimes 18 months, to go back to the pre-split price. So in other words, in 18 months, you can double your money 100%, because the price goes from 35 to 70 and you have 200 shares. So that's why a lot of good companies, when they split, there is a run up to the before a split or after a split, there's a run up in the stock price, because they are chasing the stock which just split or about to split. All right. So you understand that. So don't get panicked when you see your stock charts is all messed up and a big gap down. Either reload your chart for data feed, or next day everything will be all right. But it should be if your platform is good, it should reflect right away. And a lot of platforms, they show by date your major event occurred. So they show you the date, that on this date the split occurred, and so you have that knowledge. So this is the basic of a stock split, before and after. And now I tell you the reason why reverse split. Reverse split is when it's opposite of a split. So 2-for-1. Then if you own 200 shares, your price goes up, and then you own, suppose, 100 shares. So there's a reverse split. And the reverse split is not considered good. So split, look for the split. So reason for stock split. There are two reasons. There are many reasons, of course, but the two reasons: psychology and stocks liquidity. So the traders. Let's say Amazon. Amazon is supposed trading at 2,000 or 1,500, whatever price. I don't trade Amazon. So if it's trading at 2,000, how many people can buy Amazon, and how many people can trade Amazon shares, options? But if it's trading at, suppose they do 20-to-1 split, and it's trading at 2,000, it's like 100 shares, 100 price is 100. So too many people can trade that. So there's a psychology, and the liquidity increases also. So there's more shares available, the price is low, options are normal. So there's more activity going on in that stock. So that's the reason to boost the morality, or to boost the traders' participation, the company do the stock split. Then and if the company is good, as I said, the price of the stock goes back to the pre-split price. So everybody wins. So that's the reason the company do the stock split. All right. So now there are many kinds of stock split. Some are very weird stock split, but the majority of the stock split falls into one of these categories. Some are easy, some are hard to understand. Like 2-for-1 is easy. If you have 100 shares, if you have one share, you get two. So that's easy. If you have one share, you get two shares. That's easy. If you have one share, you get 4 shares. So that's easy too to understand. 4-for-1, 2-for-1. Now it gets complicated when 3-for-1. So if you have one share, you get 3 shares. Or they want you to get more confused, and they say, okay, so you give us 2 shares and you get 3 shares back. So now this is more complicated. This is little easier, because 1 share divided by 3, so you can do the formula. I'll show you the formula. So this is easier, but this one is more complicated. Or there could be 5-for-8 or 8-for-5, whatever, the different ratios. So as long as you understand the math, you can do the math. So it doesn't matter what they throw at you. So these are the most common stock split, and I'm going to explain some of them later. So now I'll give you the phases of the stock split. So pre-announcement. So sometimes there is a rumor going on that okay, the company is trading high price and it may split, and then there will be more liquidity. So this is pre-announcement. The company has not announced yet, but there is a rumor going on. So when a company like suppose Apple or CRM or Baidu or all these Facebook, imagine if Facebook says, okay, I'm going to do some stock split. So what happens, right? So there's a rumor. So there's not a news, but there's a rumor, and traders start chasing that stock because they think that the stock will run up, and it's a good valid reason to chase and get the stocks before the announcement comes. So this is what happened pre-announcement. There is a rumor and they start chasing. Now let's say the rumor comes true and there's an actual announcement. So when the announcement comes, so that's where it depends also on the company and growth, like Apple, Facebook. If they announce, or Amazon, Baidu, the stock moves sharply to the upside. So people buy, and there's nothing happening. It's just nothing happened, right? It's just an announcement. No changes in the book yet, but traders start chasing the stock, so the price starts going up. Then once the buying pressure goes away, there is a period where the stock is doing nothing. It just it stays because they announced a stock split like 2 months ago, 2 months before the actual stock split. So if they announce today, and the stock split will happen 2 months later, so there is activity happen for a week or so, and then the stock dies. It will just go on a flat. So this is where the stock is just trending flat. So there's nothing happening. Now, suppose they announce that it will split 2 months from now, and the 2 months is coming, the date is due, then the stock starts running again. It's like a horse get up and start running again. So the stock starts running again for further rise up. So that's what pre-split run. Now, split execution. Split execution is, for instance, they give you a date that as of today, and if split will be effective from tomorrow. So whoever buys the shares, whoever has the name on their, suppose you own 1,000 shares and you sell me today, then I own 1,000 shares and I will get to participate in a split, whatever happen up and down. You will not. So today market close, if I buy from you, then you will not get effect of a stock split. I will get it. So tomorrow morning, suppose I buy 1,000 shares from you, tomorrow is the date and split execution, and that's where in the morning you see the effect. So you should be aware of if some dramatic things happen, like you saw the gap down, you will see gap down. You shouldn't be seeing gap down because there is no gap down. Your chart should adjust. So if it doesn't adjust, then there's a data feed problem. So that's why trader lose money. One of the reasons is the data feed. The code is not right, the chart is not right, and they lose money because then they take wrong action. So that's one of the reason of losing money. So that's the mistake can cost you. A little mistake can cost you. So split execution. So today is the split, and then the stock starts running, and then it runs for a week or so, and then it dies. Then comes the post-split depression, and then it becomes normal. So activity is normal. There's nothing happening. It's just the game is over. So these are the 6 stages of a stock split. So you should be aware of. So if you don't want to either you go if you want to buy and hold shares, you buy an announcement. I mean, you can take participation in the rumor, and then just before the split, and then you can take advantage just before the split. Not all stocks will do the positive move. Some stocks just don't do anything after the split, so you don't gain anything. So just be aware of which stock is coming and how much is the split and what kind of company is this. Like Apple, Facebook have a positive effect. Okay, so let me give you example of CRM. So this is the actual date of split, 2013. That's why I kept it in my slide. I think I read it when I was preparing this presentation, so I needed an example. So this is the example I found, CRM. So I think this is an actual example of 2013. And I remember when CRM split. So if you were trading in 2013, you would know that stocks CRM split. So what happened? So the stock is CRM, date of announcement, March 21st, 2013. So they announced on March 21st that they will do 4-for-1 stock split, which means if you have 100 shares, you will have 400 shares. So it's a good thing, right? If you have 100 shares, you will have 400 shares. It's only good thing from psychological point of view that now you're happy. Oh, you have 400 shares. Sometimes you can keep the shares for long term. Suppose you only buy 1,000 shares, and it's a good company, and after 10 years you see 10,000 shares because the stock keeps it's splitting, giving you dividend, it's growing. So you see a good chunk of capital gain in your portfolio. So date of split, they announced that the date of split is April 18th. So it's like 4 weeks. 4 weeks after the announcement, the actual stock split will be April 18th. So if you buy on April 17th, then you get to participate in the stock split. So if you buy 100 shares on April 17th, on April 18th, you will see 400 shares. So far so good. So at that time, the outstanding shares of the stock of CRM was 400 million shares. So after the split, because it was 4-for-1, the split, the number of shares outstanding is 1.5 billion. So 400 multiplied by, no, it should be 1.6 billion. So the math is wrong. So 400 multiplied by 4 is 1.6 billion. So I'll correct the slide. So after the stock split, 1.6 billion shares outstanding. Now, on April 17th, so April 18th is the stock split date. On April 17th, the CRM was trading, suppose, at $170 per share. On April 18th, right at the open time, it should be trading at 42.50. Why? 4-for-1. So 170 divided by 4. So if you divide 170 by 4, is 42.50 per share, and you will own 400 shares. So your net value, your investment value doesn't change, but you get to have 400 shares. And then, but what happened? Now you have 400 shares. Let's take example, 400 shares, right? And CRM, I think, is trading at 169 right now, 170. And I have CRM in my portfolio. So now take a look. What happened in 5 years? It split at 42.50. So if you have 100 shares, you would have 400 shares. And in 5 years, it went 400% gain. So 400% gain in 5 years, right? Because 4-to-1. So if it's back to 170, if you had 100 shares, now you have 400 shares, and CRM is trading back to 170. So it's a good deal, right? CRM is trading at 140. So 140. So if it's trading at 140, it's still a good deal, right? So that's the reason people buy, and they keep it, participate in the growth. Okay. So now, what happened on the option? So if you had options on CRM, if you had shares, it's simple. But in option, so before stock split, one contract of May 170 call, suppose you own one contract of May 70 call, and one contract holds 100 shares. The price of the option was trading at, suppose, $8. So the contract May 170 call was trading at $8 for $8. What happened after the stock split? You will get 4 contracts. So suddenly you see, and this is another thing, people look at their option chain, and they said, oh my God, I bought for $8, now it's trading at $2. Something happened, and then they sell. And they don't realize that now they have 4 contracts, so their value did not change. So you have to see if the price is suddenly down, like from 8 to 2, and the charts are messed up because your broker quote feed is not right. You're seeing gap down. You're not looking at that you have 400 shares, or you're not looking at that you have 4 contracts. So your trading is messed up that day. So you need to be aware of, look at your position, and you should see 4 contracts. And the strike will be this 42.50 calls. Sometimes the strike could be weird, 0.33 or 0.67. So those are non-standard options, because they are just, they are not standard. So you will see 4 contracts of May 42.50 calls, and the price of option should be $2. So now those who cannot afford to buy $8 option based on the suppose the position sizing, their portfolio does not allow them to buy $8 contract. Now they can afford to buy CRM at $2 per contract, right? So there's more liquidity, there's more participation, and everything is positive. So that's the effect of stock split, and the reason for the company to do it. Now let's see what happens if it's a 3 for 2. Okay, so 3 for 2. So before a stock split, suppose you own 100 shares, and the price before a stock split is $60 per share. So far so good. 100 shares you own, and you have the stock price is $60. So you invested $6,000, right? You bought 100 shares at $60. You invest $6,000. Now, what this is the way to calculate the new price. So this is the formula. If you apply the formula, you will be correct all the time. So number of shares calculation. So because it's let me see, it's 3 for 2. So what you do is take the 100 shares, okay, 100 shares, divide by 2, and then multiply by 3. So for 2 shares you're giving, and you're getting 3 shares. So in other words, for 50 shares think of it this way. You will have, when you divide 100 by 2, you have 50. 50 is the denominator, and then you multiply by 3, you get 150 shares. So you're giving your 100 shares, and you're getting 150 shares. And the price also dropped by the same factor to 40. So 150, now you have 150 shares, your investment was 6,000. You should see the price of $40 per share. If the stock is trading above 40, suppose 41, you are immediately at gain. You have a gain of 150. Yeah, you should see gain of $150. If it's below 40, you are seeing the loss in your portfolio. So in other words, 100 divided by 2, because 3 for 2, and then you multiply by 2. So 100 divided by 2 is you broke it down into 2 pieces, 50-50, and then let's say you gave all those 2 pieces of 50-50, and then you get 3 pieces of 50-50, so 150 shares, and then $6,000 was your investment. You should see per share price of $40. So nothing happened in your books. 150 ideally, and ideally nothing changed. You have 150 shares, and the per share price is $40. So again, it's $6,000. All right. Now, what happened on the option price? So let's take this example. So let's say the example of the 3 for 1. You have 1 contract of June 60 call. So value of contract before split is $6,000, right? 1 contract of June 60 calls. The value of contract is $6,000. Value of 1 contract after split is again $6,000. Yeah, I think so. Maybe not the contract. I'm talking about the, I think I messed up here in the example. 3 for 1, you're holding 1 contract, value of 1 contract split. I did not specify the price. $60. Yeah. So let's yeah. I did not specify the price of the contract. So the price of the contract is $60. So you invest in the option $6,000. Now the option price will drop to 40 and your option contract will still be $6,000 value. So nothing changed in what I'm trying to say. This based on the stock split, your value, the investment value doesn't change. It doesn't matter if you own option or if you own shares. The value remains same. It's what happened after the stock split that matters. The stock usually goes up in price, and if the stock is going up in the price, the value of the contract is also going up. And if you want to find out which stocks are splitting, you go to this website on Yahoo, and they list all the stocks which are coming up for split. So this Yahoo Finance lists all the stocks, and then you can see which stocks you want to participate in this in the stock split. And even if you don't want to participate, if you're trading an option, you are aware of that the non-standard option are due to this stock split. Sometimes they have a 42.50, sometimes they have a 43.67. So different ratios, it depends on the stock split. All right. So go to this website. Again, I have a 7-month Mastering the Market coaching program where I teach more than that. This is just a little piece of information I was giving you. It goes a lot deeper and it's for 7 months. So if you're interested, send me a mail and we will talk for 75 minutes. All right. So this is my email, askus@financialmarketwizard.com. The next webinar will be on Sunday, 5 p.m. and I now cover the another topic. So just a second. Okay. All right. So this is a 3-slide topic, but this is very important, and you need to understand your beliefs and the market conditions. So I will explain this a little. Pay attention to what I'm saying. So this is a matrix, and I will explain the matrix one by one. So on the x-axis is the belief in your trading system. So every trader has a trading system. They develop their trading system. I have my own trading system I've developed over the years, and I keep tweaking it and optimizing it. And so that's all I'm doing. I'm not doing any major changes to my trading system. I just do some fine tuning a little bit, not a major change. So on x-axis, you see the belief in the trading system. On the y-axis, you see the market conditions. So there are 3 market conditions: one challenging market conditions, a difficult market condition, and then a favorable market condition. And the belief in the trading system is low, medium, and high. So far, so good. So let's understand when the trader has a low belief in their trading system, what happens when one of these market conditions are occurring. So let's say the trader has a low belief in the trading system. He has just come across the trading system. Maybe he bought a software or some indicator, and he doesn't know how that indicator or the software works, and he's just trying out. So, but he has a low belief because he just got that trading system. So when the market conditions is favorable, so when the market condition is favorable, he's making money. And when he's making money, he's overconfident. So the trader goes into overconfidence mode. And he thinks that, everything is so good. I'm making money. But he has a low belief in the trading system. He's not sure yet, but the market condition is good. So he is kind of overconfident that this is it. This is what he has found, a holy grail, and this indicator really works. So now what happens? He still has a low belief in the trading system, and suddenly the market conditions change to a difficult level. So market is going up, down, going up, down. It has become difficult. So what he does, he starts ignoring the signals of the trading system. So if the trading system is telling him to stay away from the market, he's just ignoring it. Or if the trading system is saying to reduce his exposure, He's ignoring it. He is just ignoring the trading signals and incurring losses. So he starts incurring losses because the market conditions change. He doesn't know that the market condition has changed. He's just having a low belief in the trading system. So he's going through overconfidence level to ignoring the signal. Then the market conditions become very challenging, and he doesn't realize that because he doesn't have any system to evaluate what is the market condition. So he's not realizing that the market has changed. The system is still the same. So he abandoned the system because now either he doesn't know how the system works, and the system is not working properly because the market condition has changed. He's expecting something else, and he just do all kinds of silly mistakes, and he abandoned the system because he has a low belief in trading system. He says, no, this system is not good, this indicator is not good. Whereas what happened is the trading system is still the same. It's just that the trading system is not producing giving him enough either the signals to trade, or the trading system is telling him to get out. He's not getting out, so he's not following the system because he has low belief, and the system is not giving him this result what he was getting here because the market condition has changed. So he abandoned the system. Okay. Now, let's say the trader has been using the system for a while and he has some sort of a medium belief. So let's assume that he has a medium belief in the trading system. So what happens when he has a medium belief in the trading system? Because he has gone through this phase. He was when the market condition is good, he was overconfident, but now he's a little tense because he is favorable, but he is tense every day. He says, okay, I don't know what the system will do or not do. He cannot handle the market, the system. He is still trying to understand the system, and he has not mastered it. So he is still tense. And then what happened when the market conditions become difficult? He becomes skeptical. He becomes doubtful. He says, okay, this I don't think the system will work, and it has fault. There's nothing fault in the system. It's just the market has changed from favorable to difficult. So again, he has become skeptical. Instead of being confident, he's skeptical. Now, what happened? He has medium belief, but the market conditions suddenly become very challenging. So he starts modifying the system. He starts tweaking the indicator. Suppose it was a 20-day moving average. Now he says, okay, I think I should, this 21-day moving average looks good. If it's a simple moving average, then he thinks, okay, I need to go into exponential moving average. So he's modifying this, he's modifying that. And he's adding another indicator, and all this kinds of scenarios going on, and he doesn't realize that the system is the same. He cannot, the market has changed, so he's not paying attention to the market. He starts modifying the system. So this is what the from low to medium, these are the 6 phases of the trader's belief. Based on the belief the trader goes through. Now, if the trader has high belief, if he has high belief in the system because he has seen the past results of his system, how it works, what happens when the conditions are favorable, he's relaxed. So he is relaxed. His system is producing the trades. He's taking the trade. He's following his rule. He's putting the money in each trade based on what he has determined before, that this is the money I'm going to put. This is my stop. This is my targets, and worst come worst, I will get out at these prices if the market becomes difficult or challenging. So he because he has a high belief in trading system, he has been around using this trading system, right? So now if the market becomes difficult, so he's not relaxed, but he's confident that the things will turn around because he has seen the past performance of his trading system. So he knows that I need to, I'm confident that the system will, my trade will be positive at the end after the market moves from this difficult conditions. Now, if the market becomes challenging and he has a high belief, he's patient. So he just stays patient and don't do anything. You just wait it out. So so now it depends. So it depends where your belief is in the trading system. If you have a low belief in trading system, you will see one of these things going on with you. And if you have a medium, you will see one of these. Ideally, you should be in one of these three quadrants. Either you're relaxed every day, or you're confident, or you're patient. So it's not you, it's not your trading system, it's the market conditions. Market conditions have changed and you are not adapting yourself based on the conditions. You're not reducing the exposure, you're not doing things what your market is telling you to do. So if you are doing what based on the market, then you are going through one of these conditions. So sometimes the market condition is favorable and you have a high belief in trading system, you increase your exposure for each trade or based on the portfolio or towards that direction. Whereas if the market condition is challenging, you are patient and then you are reducing the exposure. So you are going high speed, medium speed, low speed, instead of doing all these things, ignoring it, being skeptical, tense, modifying the system or abandoning the system. You're not doing any of these six things. You're doing one of these. All right. So it's very important for you to understand your trading system and build confidence and belief in your system. All right. So this is it. And if you have any questions, please send me an email and I will answer. And the next webinar, I think, will be on Sunday and you will receive the email. Thank you for coming.